I lost everything in the 2008 recession. That's what my neighbor told me during a severe market downturn. But what if I told you recessions aren't wealth destroyers, they're wealth transferers, like a storm that clears the path for new growth? Today I'm breaking down the 6 specific ETFs that have historically outperformed during market crashes. These investments have earned their place in my own portfolio as preparation for the next downturn. I'll show you how to implement this strategy effectively, positioning yourself to potentially transform market uncertainty into opportunity while others panic. The approach might surprise you, but the historical results speak volumes. What if I told you that the richest investors actually look forward to recessions? This might sound counterintuitive, but there's a powerful reason why financial elites see market crashes differently than most people. When everyone else sees disaster, they see opportunity. During market downturns, a psychological divide emerges between average and strategic investors. Most people make decisions based on emotion rather than data. When portfolios plummet, their brains shift into survival mode, selling at precisely the wrong moment to stop the bleeding. Headlines during past crashes reveal this pattern. Billions flowing out of markets just before recoveries begin. Strategic investors navigate these turbulent market seas with a different compass. While others are tossed by emotional waves, they chart their course by steady stars of historical patterns and fundamental value. They recognize major market corrections as rare events occurring roughly once per decade. Instead of fleeing the fire, they advance toward it, equipped with cash reserves and watch lists of quality assets suddenly available at steep discounts. Warren Buffett, having weathered numerous financial storms across 7 decades of investing, distilled this wisdom perfectly. Be fearful when others are greedy, and greedy when others are fearful. His years of experience navigating market cycles offer guidance for investors facing today's volatility. The wealth transfer mechanism becomes evident when examining historical data. Following the 2008 financial collapse, as panicked sellers liquidated positions, disciplined investors who continued purchasing quality companies saw their investments grow by over 400% in the subsequent decade. This wasn't mere luck. The pattern repeated during the COVID crash of 2020, where strategic buyers who acquired assets amid the uncertainty doubled their investments within 2 years. Psychology explains why most investors make costly mistakes during downturns. Fear triggers protection instincts when markets plunge. Herd mentality pushes people to follow the crowd selling. Loss aversion, the psychological principle showing losses hurt twice as much as gains feel good, completes this problematic triangle. Consider Bank of America during 2008. Shares plummeted below $3, losing over 90% of value. Today, those shares trade above $40, representing a 1,300% return for investors who recognize the crisis as temporary. Similarly, Disney lost nearly half its value in weeks during 2020, creating a fleeting opportunity for prepared investors. The challenge lies in identifying which companies will emerge stronger post-recession. ETFs provide an elegant solution, offering entire categories of recession-resistant assets through single purchases. They deliver instant diversification and professional management without requiring analysis of dozens of individual companies. Certain ETF categories have historically performed well during market turbulence. These carefully constructed portfolios are designed to thrive under specific economic conditions. The right allocation can transform recessions from threats into wealth-building opportunities. The strategy isn't about perfect market timing. Even professionals can't consistently predict exact turning points. Success comes from thoughtful allocation to recession-resistant assets before volatility strikes, maintaining stability while others panic, and deploying resources when quality assets go on sale. Recessions transfer wealth from emotional sellers to patient buyers, from the unprepared to the prepared, from short-term thinkers to long-term investors. By understanding which ETFs perform best during economic stress, you can build a portfolio resilient enough to weather storms while capitalizing on inevitable opportunities. Now let's look at the first ETF category that has historically maintained stability even when markets are in free fall. And it's one that central banks around the world are currently stockpiling at unprecedented rates. Did you know that central banks worldwide are currently stockpiling gold at the fastest rate in decades? There's a reason the smartest money in the world is rushing to this asset. When financial authorities with trillions under management make a move this significant, smart investors pay attention. Gold ETFs serve as financial insurance policies during times of economic uncertainty. Like a fortress that protects your wealth during an economic siege, gold has maintained its value for thousands of years while proving its worth during modern market crashes. During the 2008 financial crisis, while the S&P 500 dropped nearly 40%, gold increased by over 25%. This precious metal moves independently from stocks and bonds, creating a crucial diversification effect when you need it most. Many investors dismiss gold as a dead asset that doesn't generate income. This perspective misses gold's essential role as a counterbalance to falling equities during market turmoil. For those seeking gold exposure, IAUM, iShares Gold Trust ETF, offers an efficient solution with just a 0.09% expense ratio, only $9 annually in fees for every $10,000 invested. Most financial advisors recommend a 5 to 10% allocation to gold, providing meaningful protection without sacrificing too much growth potential during normal market conditions. While gold shields you from volatility, dividend value ETFs maintain cash flow when markets are in disarray. These ETFs focus on companies with long histories of maintaining their dividend payments regardless of economic conditions, providing both psychological and financial benefits during market downturns. Companies that maintain dividends during recessions demonstrate exceptional financial strength and high-quality management. This ability reflects strong balance sheets, minimal debt, sustainable business models, and forward-thinking leadership, qualities essential during economic turbulence. SCHD, Schwab U.S. Dividend Equity ETF, stands out with its 4% yield and minimal 0.06% expense ratio. With every $10,000 invested, you receive approximately $400 in annual dividends, while paying just $6 in fees. SCHD concentrates on sectors that historically weather recessions better: consumer staples, healthcare, utilities, and select industrial companies with stable cash flows. Dividend reinvestment during market crashes creates a powerful compounding effect. Consider the story of Richard, who continued reinvesting his dividends during the 2008 to 2009 financial crisis. By 2012, his portfolio had not only recovered, but significantly outperformed those who had paused their investments, as he accumulated substantially more shares at discounted prices during the downturn. The real magic happens when combining gold and dividend value ETFs. A strategic allocation of 5 to 10% to gold through IAUM and 15 to 25% to dividend stocks through SCHD creates a foundation that provides both stability and income during market turbulence. This combination addresses two major challenges investors face during recessions: portfolio volatility and income reduction. By dampening the emotional impact of market swings while maintaining cash flow, you're positioned to make rational decisions rather than panic selling at the worst possible moment. This foundation provides the stability needed to potentially buy other assets at discount prices during market downturns. While this foundation is crucial, it represents just one part of a comprehensive recession strategy. Different economic scenarios call for different protective measures, as gold and dividend stocks perform differently across various downturns. Now let's explore how balanced ETFs can provide an all-weather approach to handle any economic condition, specifically designed by one of the world's most successful hedge fund managers to perform in all four economic environments: growth, recession, inflation, and deflation. What if there was an ETF specifically designed by one of the world's most successful hedge fund managers to perform in any economic environment? That's exactly what we have with the ALLW ETF, which implements Ray Dalio's famous all-weather investment philosophy. Dalio, founder of Bridgewater Associates, created this strategy after decades of studying how different assets respond to various economic conditions. The beauty of this approach is that it doesn't require you to predict what the economy will do next. It's built to handle whatever comes. Most traditional portfolios are constructed primarily for growth environments, when the economy is expanding and markets are rising. That's why they perform well during bull markets, but struggle dramatically during recessions. The problem is that these portfolios aren't balanced against the four major economic scenarios we can face: growth, recession, inflation, and deflation. Each of these conditions affects different assets in different ways. The ALLW ETF takes a completely different approach. It creates a meticulous balance of uncorrelated assets, investments that don't all move in the same direction at the same time. This strategic diversification makes it effective across various economic environments. While your typical investment portfolio might contain 60% stocks and 40% bonds, the all-weather strategy uses a more sophisticated allocation model. ALLW's allocation includes 30% stocks, split between U.S. and international markets, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, and 7.5% commodities. This mix is carefully calibrated to respond differently to each economic scenario. During growth periods, stocks drive returns. During recessions, long-term bonds typically appreciate. During inflation, gold and commodities help protect purchasing power. And during deflation, bonds tend to perform exceptionally well. While ALLW provides excellent diversification, high-quality bond ETFs offer another crucial layer of protection. Think of ALLW as the foundation of a recession-resistant portfolio and quality bonds as the shock absorbers that smooth out the ride during market turbulence. Quality bonds often move inversely to stocks during downturns as investors seek safety, driving up bond prices while selling riskier assets. For this bond allocation, VBIL, Vanguard 0 to 3 month Treasury Bill ETF, stands out with its combination of safety and yield. With just a 0.07% expense ratio, you'll pay only $7 annually in fees for every $10,000 invested. VBIL currently yields approximately 4.2%, a substantial return for an exceptionally safe investment. These treasury bills are backed by the full faith and credit of the U.S. government. VBIL's short-term government bonds provide both protection and income, with minimal interest rate risk, making them less affected by fluctuations when the market becomes volatile. Their combination of safety, income, and liquidity makes them ideal for the defensive portion of your recession portfolio. When you combine balanced ETFs like ALLW, 20 to 40% of your portfolio, with short-term bond ETFs like VBIL, 15 to 30%, you create a powerful safety net that can help protect your wealth during market volatility. This combination provides several layers of protection: diversification across multiple asset classes, exposure to investments that typically perform differently than stocks, and a steady income stream that continues regardless of market conditions. This strategic allocation helps address one of the biggest mistakes investors make during recessions: selling quality assets at market bottoms due to fear. When a significant portion of your portfolio is designed to remain stable or even appreciate during market stress, you gain the resilience to hold your ground when others are panicking. Now let's examine two sector-specific ETFs that focus on companies selling products and services people need regardless of economic conditions, businesses that tend to maintain stronger revenue and earnings even when the broader economy struggles. Have you ever noticed that even during the worst economic times, people still buy toothpaste, soap, electricity, and water? There's a powerful investment lesson in this observation. While consumers might postpone buying a new car or vacation during a recession, they rarely cut back on essential items needed for daily life. This consumer behavior creates a unique opportunity for strategic investors. Consumer staples ETFs focus on companies that sell products we simply can't live without. Like the foundation of a house, these businesses provide your morning coffee, toothpaste, soap, medicine, and basic food items. What makes these companies special is their ability to maintain steady cash flows regardless of economic conditions. During the 2020 pandemic, while restaurants closed and travel halted, grocery stores saw record sales as families stocked up on essentials from Procter & Gamble and PepsiCo, companies found in consumer staples ETFs. The resilience of these sectors during downturns is remarkable. During the 2008 financial crisis, consumer staples stocks declined by only about half the amount of the broader market and recovered much faster. This pattern repeated during the COVID-19 crash, with essential businesses continuing to operate while discretionary companies faced shutdowns, reflecting the non-negotiable nature of these products. For investors seeking consumer staples exposure, VDC, Vanguard Consumer Staples ETF, offers an excellent option with a mere 0.09% expense ratio, meaning you'll pay only $9 annually per $10,000 invested. With a dividend yield of approximately 2.4%, VDC provides more income even during market downturns. This income can be reinvested at potentially lower prices, accelerating wealth building when markets recover. VDC's portfolio includes 103 household names like Costco, Walmart, Coca-Cola, and Philip Morris International. These companies benefit from massive distribution networks, strong brand recognition, and pricing power that creates remarkable resilience during economic downturns. Moving from everyday products to essential services, utilities represent the economy's backbone, the infrastructure that keeps everything functioning. Like the electrical system in your home, utilities provide services considered absolutely necessary. Demand for water, electricity, and natural gas remains constant, even when economic conditions deteriorate. Utilities operate as regulated monopolies, with guaranteed service territories where they're the exclusive provider. This creates predictable cash flows and earning stability few other businesses can match. Their regulator-approved rates typically allow for modest but consistent profit margins in all economic environments. For utility sector exposure, XLU, Utility Select Sector SPDR Fund, offers a low-cost option with a 0.08% expense ratio and approximately 3% dividend yield. XLU holds 31 major American utility companies, including NextEra Energy and Duke Energy, infrastructure providers with consistent earnings and strong dividend histories. Historical performance shows utilities' defensive strength. During the 2001 recession, utilities actually gained value while the broader market fell. In 2008, they declined less than the overall market and recovered more quickly. Allocating 10 to 20% to consumer staples ETFs like VDC and 5 to 15% to utilities ETFs like XLU provides exposure to necessity-based segments of the economy. These percentages reflect the balance between defensive protection and growth potential based on historical drawdown patterns. This allocation creates a foundation that helps maintain portfolio stability when more economically sensitive sectors experience volatility, giving you both financial and psychological stability to potentially capitalize on opportunities when prices fall. Now let's put all these pieces together into a complete recession-ready portfolio model. Let's put everything together into a complete recession-ready portfolio. Your allocation breakdown looks like this: 10% gold through IAUM, 20% dividend value with SCHD, 25% balanced approach with ALLW, 20% short-term bonds via VBIL, 15% consumer staples using VDC, and 10% utilities with XLU. When implementing this strategy, dollar cost averaging over 3 to 6 months creates your financial fortress systematically. This disciplined approach helps you avoid allocation changes at potentially wrong moments. Remember, those who build wealth in recessions do so through preparation, patience, and having the right tools while others panic. Your strategy becomes your financial shield, transforming market chaos into opportunity for long-term growth.